welcome to the Lego Limited mock test. This question addresses that planning stage in the audit. Quite a few questions out of limited number of marks. So this is really important that when you get to the required, you work out how much time you have and you answer sticking to that time, because you may have more relevant points, but you are going to be capped based on what the mark allocation is. Okay, so let's get into what you should have picked up in your 12 minutes of reading time. You are a first year trainee, so just to understand my experience being junior, I shouldn't be left to do everything on my own. At CA Campus Inc., herein referred to as CAC, a firm of registered auditors. CAC is medium-sized audit firm. So now I've just got an idea of my audit firm size. I expect that I should be then taking on clients that are also medium-sized to ensure compatibility. In South Africa, with offices situated in all of the major cities. So this means that if our client has a decentralized operation within South Africa, we potentially have the staff to be able to go and audit. You have been assigned to the audit of Lego Limited Group. So from here I can see they are public, and so I know they have to comply with the Companies Act specific requirements of having a company secretary, audit committee and external auditors. So the fact that we are there is a good thing. They are a group, so automatically I've got the risk at the financial statement level because they are a group. I'm not going to put down all of those risks here because maybe this isn't going to be asked, but in my head I'm thinking group. There's the risk that related party transactions are not at arm's length and they're not disclosed. There's the risk that the consolidation is complex, so there could be errors. Intercompany transactions may not be eliminated, and the accounting policies may differ between the companies that are being consolidated, so there could be errors there. Okay, herein referred to as Lego for the year ended 28 February 2019. So now I understand the year that we're dealing with. CAC has been the auditors of Lego and its foreign subsidiary. So now I go, foreign subsidiary. We got a risk at a financial statement level because we've got an additional risk with regards to the complex consolidation because there is now a foreign subsidiary that needs to be translated into the functional currency of the group in order to be consolidated. So more risks of material misstatement there. There's also the risks of non-compliance with foreign regulation, which could result in penalties. Plastic Limited, so also public, and therefore needs to have company secretary, external auditor, and audit committee. For the past 3 years, so now what I can see is we are continuing as auditors, which means opening balances don't have a risk. We've got knowledge of this client, so that's great. Background information. Lego specializes in the manufacture and retail of plastic toys, with their signature line being the Lego blocks. And I understand what industry they're in. And I can automatically say, yeah, with regards to manufacture, there could be a risk at the assertion level for your valuation of your inventory, work in progress, finished goods, because they actually manufacture it. Lego was established in 1945, so they've been around for a while, and this makes me think that they should be able to pay the fee if they've been around for a while and obviously are continuing, and has enjoyed many years of success as the leaders in the toy industry. So I can see everything's positive. In November of the current year, a competitor, Leno, entered the market, and for the first time since incorporation, Lego is experiencing a drop in market share. So now we've got a competitor, so we've got a risk at the financial statement level, potential going concern issues. If this competitor is going to affect their business, this drop in market share indicates this risk is in existence. In order to regain the lost market share, Lego management have applied to list on the Johannesburg Stock Exchange. So they've applied to list, which means now we've got a risk of financial statement level that they might intentionally misstate to meet the listing requirements because they want to list. We don't have that second listing risk that they might not meet the requirements and have penalties because they haven't listed yet. So it's only that one listing risk that they might intentionally misstate to meet the requirements in order to be able to list. The listing is dependent on the results of the 28 February 2019 audited financial statements. So we've got an additional risk here because listing is dependent on the financials. So once again, they might now misstate those financials in order to appear in a better state to be listed. And as such, management have requested the audit be completed by 30 March 2019. So now we've got a risk at the financial statement level because of this tight deadline. We've got a month to do that. And guys, it's two risks. The risk the client faces that they don't have enough time to pick up errors to account for subsequent events or post-reporting date events. And then the risk with us that we don't have enough time to complete the audit the way we want to, and so we don't pick up misstatements. In order to meet the audit deadline, the partner on the audit, Frodo Baggins, assigned 3 first-year trainees, yourself included, to the audit for the full month of March. So now, I'm looking at these and I'm going, this is a big client, leaders in the industry, and they have a group, but we've got 3 first-year trainees assigned in the month of March, which means if they started in January, they've only had 2 months experience in auditing, let alone with specific clients. So what I can see here is there's a concern with the audit team in terms of their competence, in terms of their knowledge of the industry, of the client, and so on. Even though they're taking a full month dedicated, you don't have enough experience there. The partner and 3 clerks will fly to China for a week during the month in order to complete the audit of plastic and leave the final week for the audit of the consolidated financial statement. So now all of a sudden when we look at it, we're going, they've got 1 month to complete 2 company audits and a consolidation. So now I'm going, is there sufficient staff? We've already looked at the experience, but is there sufficient staff? And in addition, do they have knowledge of the China regulations that this Chinese company, obviously, plastic has to adhere to? You are familiar with Lego blocks, and therefore the partner felt you would be best suited for the audit. So once again, you can see here that this is not appropriate. Just because I've played with Lego blocks in my life does not mean I'm capable to do the audit. While you are stationed in South Africa, each clerk will be required to visit the various manufacturing plants and the central dispatching warehouse in order to perform test counts of inventory. So this tells me that they are decentralized. Risk at the financial statement level. And if they're decentralized, if they don't have controls operating effectively at the various branches, locations, there could be errors happening throughout. You had a meeting with Harry Potter, the financial director, in order to gain an understanding of the significant events that took place during the financial period. Harry Potter informed you that the CEO, Tinky Bell, has been placed on suspension while the allegations of fraudulent misconduct were being investigated. So now we've potentially got a risk at the financial statement level with management integrity lacking if this CEO is actually acting fraudulently. A whistleblower has provided footage of Tinky Bell falsifying customer orders, manipulating bank statements, and creating false documents to support the year-end journals process. So already we can see that there's going to be risks at the assertion level with regards to your occurrence of revenue. There's going to be risks at the assertion level with regards to bank. We don't know what manipulations there would be at this point, and to the year-end journal entries. But that's the specifics. What I've noted initially is that anything could be misstated if management integrity is lacking. Harry Potter requested that you do not make contact with Tinky Bell, but promised to provide you with any information required for the audit. He concluded the meeting and presented you with the draft consolidated financial statements. So here we've got the draft for 28 February 2019. We've got Legos 2019, Plastics 2019, the consolidation for 2019, and then we've got Lego for 2018, so the prior year. Looking at financials, why would they potentially be giving it to me at this point? I'm thinking in the planning stage, either it's to consider going concern risks or materiality is going to need to be calculated. So I look at it, I've only got assets and I've got equity. Okay, so important, let's do the consideration between total assets and liabilities, and we can see that they appear to all be solvent because total assets all exceeds total liabilities because equity is added in to get the match to assets. Current assets to current liabilities, if I quickly look here, we can also see here that they all exceed, and so they are liquid. So I'm not too concerned with going concern. I'm just looking out here. That's all I'm really going to assess at this point. I do see there's an N1, so I need to see what that is about. And we've got notes to the financial statements. They say Lego inventory comprises of the following: raw materials and finished goods. That's the total. So at 28 February 2019, there was no work in progress. So I initially had a risk at the assertion level for that, but I don't have to worry about this because manufacturing had ceased on the 25th of February 2019. Raw materials are purchased from plastic in their functional currency. So now I've got a risk at the assertion level with regards to the specific purchase and ultimately if it forms part of inventory at year end, the accuracy of the translation, and potentially at year end, if there is any goods in transit, we might record an incorrect period, so the cut-off of the purchase and for specific inventory goods in transit. Completeness or rights for that. And have a 1 week lead time. So that means there could be goods in transit that will be arriving within a week, but risk and rewards have transferred, and so they should be recording it. Raw materials are purchased on a FIFO basis. So just to remember this, because they're going to have to be remeasured at year end. So we could have a risk at the assertion level with regards to our raw materials in terms of valuation if they are not remeasured to the FIFO rate at year end. Finished goods comprise of different types of Lego blocks. Finished goods are measured using standard costing, so automatically we've got a risk at the assertion level with regards to your inventory valuation because there is complexities in determining the standard costing, there's complexities in calculating the variances that arise as a result of those and then ensuring they are correctly accounted for. The production manager maintains an overhead allocation schedule, and this is used to allocate overheads to the inventory. So we've got an assertion level risk here with regards to your inventory valuation if they are allocated incorrectly. Inventory is accounted for using a computerized perpetual inventory system. So I know that there should be a record of everything that's happening, and this computerized gives me risks at the assertion level with regards to your inventory in terms of valuation. If that system doesn't have the necessary controls to ensure that everything is recorded and there's no manipulation, but it also says to me, maybe I can use CATS for the audit of inventory because they have a computerized system for it. Got a working paper 1, which is system description for the sale of Lego blocks. And it says, Lego blocks are sold in bags of 50 pieces or 100 pieces. On receipt of a purchase order, so I can put here my documents, purchase order, from a customer, Peter Pan, the credit manager, performs a credit-worthy check. So I've got a good control here. And only if the customer has sufficient credit is the order approved. We've got authorization here, so that's great. So I can say here, from here, we've got credit-worthy check and credit limit check. And then if we're happy, the order is approved. An internal sales order is then sent to the central warehouse from where the Lego bags are dispatched. So now we've got an internal sales order. The warehouse dispatching staff pick the number of bags requested, then prepare the delivery note and hand the delivery driver 3 copies of the delivery note. So next we've got the delivery note. What I am starting to see here already is there is segregation of duties, which is great. 3 copies of the delivery note, so a multi-copy, which is good source document design. They also load the Lego bags into the delivery van. The delivery driver then agrees the number and type of Lego bags loaded to the first copy of the delivery note and signs this as evidence that they agree. So we've got a recon here by the delivery driver, and we've got isolation of responsibility or authorization, the fact that there's a signature there to show he's done the work. Gate control are required to inspect the delivery van when leaving the premises and agree the number and type of Lego bags to the delivery van in the delivery van to the delivery note. So once again, we've got another control here, recon, and it's done by gate control. Gate control then sign the first copy of the delivery notes as evidence of the control being performed. So once again, we've got some isolation of responsibility, and send the delivery note to the accounts clerk, Cap Hook, for invoicing. So now's my first concern here. I could have a risk at the assertion level with regards to the occurrence of revenue if they are recording inventory before the risks and rewards transfer. Just because they've checked the goods to the delivery van doesn't mean the customer is going to get those goods and accept those goods, and it's only at that point that risk and rewards transfer. The customer is required to sign the second copy of the delivery note on receipt and acceptance of the Legos. So once again, isolation of responsibility and or authorization when the customer signs. The second copy of the delivery note is then sent to Cap Hook for reconciling purposes. So we've got recon, but not for invoicing. So once again, we could have an issue here. The third copy remains with the customer. On a weekly basis, the sales manager, Robin Hood, performs a reconciliation of orders to delivery notes. So we've got another control here by another person, so segregation of duties is good again, in order to identify any outstanding orders, and he then follows up on all outstanding orders. So we've got some good controls in this process, even though we're looking at some problems. So let's look at your required.